Okay, start.
Hi all, welcome to Freefloat. This is our episode of all things happening in crypto land. And for that, we have Tejaswi, a dear friend of mine, and Kishan. Kishan and I are kind of hangers-on asking all the questions. Tejaswi is a real expert. And today, we're going to be discussing something really cool. It is called DAO. I let Tejaswi even expand the acronym because I'm not really sure what it stands for. But when I heard about it, it sounded really awesome. What if you can code up an entire organization? What if you can code up an entire bank, right? So how cool is that? So anyway, I'll let Tejaswi take this away.
Yeah, so a DAO stands for a decentralized autonomous organization. I think all the three keywords are important there. It has to be decentralized, it has to be autonomous, and it is some sort of an organization. And when I say organization, I am specifically talking about for example, in the real world, if you have an organization, the organization is governed by a bunch of laws or like a bylaws, or there is a code of conduct, and the organization has a purpose. They meet from time to time and do something with their time, right? And then, of course, autonomous means that this particular organization, which is decentralized, is kind of self-governing, or it is autonomous in a way in which no human is actually involved in making it run every day, in some sense, or at least no designated human is involved. Maybe there are people who take turns to kind of do some things, but there's no specific human in charge. And it's decentralized in the sense that it doesn't have a physical address. There is no PO box number, or there is no actual address where there is a registered office or something. It is a entirely online digital organization that doesn't even have a single server. For example, you could say that an organization could live on a specific server at a specific IP address. That's not even the case here. It is this organization that lives in a whole network of computers, which is not even controlled by a single hardware or a cloud operator as well. So it's decentralized in a very fundamental way, and it is autonomous in a fairly fundamental way. And the organization part is mostly about the idea that whatever it does is coded up in some sort of a computer language where we can understand what the organization's motives are and what is the everyday activity that happens. For example, an organization could be about a credit issuance, right? So you could think of it as like, or in Indian context, let's say an organization could be a chit fund. A chit fund is a very classic organization in India, for example, where you have these bunch of people who come and pool some capital together, and somebody who needs the money will be able to bid for the lowest amount of capital they want to withdraw from the pool. And whoever doesn't need the capital for a long time, they tend to profit more because the interest rate for the guy who withdrew the capital early, or at least the person who withdrew the capital early, will have to keep paying back the principal, and the last person who stays in the pool gets a lot of money. So this kind of an organization, currently in India or in anywhere else in the world, is run by a single person or a registered organization like a Shriram Chit Fund or something like that. But if this entire thing, for example, lives on a decentralized network of computers where anonymous participants will pool their capital together, and we can discuss what this capital is, because there is no way you can pool in dollars together, because dollars have a physical kind of representation, and that is not easy to pool into a decentralized network. But let's say there is a way of kind of imagining capital that pools together, and then there is a bunch of software rules or software programs that decide this whole chit fund logic, which is, every month there is like a meeting of sorts, like where people come together, or all these anonymous identities come together, and every anonymous identity will bid on the lowest amount of capital it wants from the entire pool, and that lowest amount of capital is given back to it. And then every month the anonymous identity has to come back again and deposit the money again and again. So this entire logic can be put on a blockchain. Blockchain is basically a fancy word for a decentralized network of computers, which is not a single computer. There's no single IP address. It's a decentralized network of computers. So this is an example of a DAO. We could have an online chit fund which is not controlled by a single person. It is controlled by software, and it works.
But I think here's where the analogy breaks down, right? Because I think last month we were discussing the the whole idea of borrowing stuff, in Ethereum, for example, it needs to be over collateralized because there's no such thing as credit. So when you try to stretch the analogy of a chit fund to this DAO, the question arises. So supposing I want to borrow funds from the chit fund this time around, which means I have to actually over collateralize it. So how does that work in this scenario?
So over collateralization can be in any kind of other asset that you value, but you don't want to liquidate right now. So, for example, let's say a person owns a bunch of Bitcoin, and they believe that Bitcoin will go to the moon or whatever. They believe that Bitcoin is eventually going to become a lot of it's going to accrue a lot of value. So they don't want to liquidate that, but they want to now borrow some capital, which can be used for other things, for whatever else they want. So this Bitcoin can become your over collateralized collateral, and you can start withdrawing your Ether or some other currency you want.
Right.
And of course, the protocol, which is running the chit fund, will wait for you to come in every month and deposit that loan that you have taken back, or whatever chit fund principal you have to pay back every month, right? Or installment or whatever it's called. If that doesn't come back, the protocol has the right to liquidate your Bitcoin as a part of the process, and it will kind of make itself whole in some sense. The protocol's job is to kind of survive. So what the protocol does is the protocol will monitor the collateral and will liquidate the collateral in case something happens. This is generally the lending in all of cryptocurrencies and smart contract land. Any sort of lending which is over collateralized works like this. I mean, it's a classic, similar to like how brokerages operate margin accounts, right? You have over collateralized and you liquidate the asset to make yourself whole again. And of course, if
so this is more like a gold chit fund, in the real world, right? Because if you go to borrow against gold, you need to first give gold, right? Yes. And there is a 30% haircut, yes. And Muthoot or whatever will give you the other 70%. But what if there are other people in the chit fund who are actually contributing the money, right? And if you want to borrow from the chit fund, you have to first give the gold and get that 70% out. Exactly. So that's basically, yeah.
So that's pretty much how. So here the gold was the equivalent of Bitcoin was the equivalent of gold that I used as an analogy there. So the key difference, of course, is that this entire architecture of liquidation every month, people coming together, it's all kind of coded up already. This entire concept is coded up, and that makes it autonomous. And the organization, of course, is the idea that it's a bunch of rules that you are following, and it's decentralized because nobody can stop this. If somebody doesn't like this chit fund to be run because whatever it is, pooling money of drug lords or whatever, right? Then they don't know where to go and stop it. There is no real place to there's no kill switch in some sense. You can't go to a server and say, you can't go to Amazon and say, hey, Amazon, you have to stop this particular account or whatever, right? So there's no such kind of identity who controls it. And that, of course, this is the idealization of the idea itself, or the ideal representation of the idea. So in reality, there is a lot of there's a lot of gotchas, in the sense that sometimes these contracts are not truly, I would say, autonomous, in the sense that there will be some privileged actors who could change the code on the fly to make certain changes to take care of. Of course, they will say that they have this special privilege because they want to take care of hacks and stuff like that. But hack is a very general word. You could like this African exchange apparently a couple of days ago claimed that it was hacked, and you never know whether it was really hacked or not, right? I mean, the guy could just claim that he was hacked and he runs away with the money. So anybody who wants to get involved in a DAO has to ensure that they know what they're doing, and the code is like kind of well understood, where there are no loopholes or there are no gotchas, where the promoters of the organization, so to speak, even though they are anonymous identities, sometimes they have some real world personality, like they might be Elon Musk or somebody, right? And then you kind of make sure that they don't have privileged access and stuff like that.
So this begs two questions. So one is like last month we were discussing about Tether and USDTs, right? Where there's a 1:1 backing for every token that is $1. Is there an equivalent for gold in the crypto land? So where it's like gold tokens?
That's a good question. I don't know actually, because like it's the equivalent of the gold ETF, right? GLD.
Yeah.
I have a feeling it should exist because it's a very obvious thing to have, but I don't know. I've never heard of this though. There's no BGLD or whatever. I have never heard of this. I will look it up though. Like we can put it on the show notes later. But I have a feeling it should be there because it's trivial to have it.
Yeah.
You basically have an equivalent amount of gold, and gold to Bitcoin or gold to like whatever token price conversion is fairly easy. And yeah, you just basically store gold in a vault, and that's good to go.
Because I feel that basically if you have a gold token, crypto in India will just explode. Because because here the biggest problem people have is they have assets, fixed assets, especially in gold form lying all about. So if there is an easy way to just say that, look, this is the gold I have, I'm going to voluntarily keep it in a locker. Here are the keys to the locker. Now issue me gold tokens that can exist in crypto land. There'll be like some billion people trading that every day.
But I guess the problem is it's also about trust, right? I mean, here we assume that the person who holds the gold in the vault will not issue more tokens than what is backed by the gold, right? And
yeah, but that's true about that USDTs as well. So everything that Tether has said about it is, it's now escalated to a point where US
Fed is talking about it. Yes,
they're like shitting their pants. They're saying this could blow up on our faces.
It's a systemic risk to the entire ecosystem or whatever, right?
Yeah.
It's possible. So the thing is, I have a feeling that Indians are a little bit more conservative in terms of trusting custodians, because even when the gold ETF kind of thing started in India, it was not as popular as people would have preferred. Even the gold scheme that the government launched, where they would allot gold. It's what some Suvarna, some scheme, right? Even that didn't have too much uptake, I thought.
Yeah. So the thing is, people don't want to give up gold ornaments. So, so that was a non-starter. But the sovereign gold bonds, where instead of buying physical gold, you just buy a bond that pays 2.5%. That's a super hit.
Because it has a yield coming from it, right? That's the key part there.
It has a yield, and it has very favorable tax treatment. So the whole thing is tax-free. The coupon is tax-free, and the capital gains on it is tax-free at the end of 8 years. So all new buyers who used to buy these gold biscuits, and on the flip side, right? So if you have white money, it makes no sense to buy gold biscuit because you have GST and you have making charges, you have all these blah 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 blah.
Also custody risk, man. I know people who have lost gold biscuits.
Yeah. So and yes, so you need to pay the bank locker, and according to the rules and regs, bank is not responsible if somebody loots the locker. They're not responsible for your shit. So so the thing is, most people with legit cash who want to invest in gold just go to SGB, trust.
Yeah, the sovereign gold fund, huh? Okay. Yeah. No, but yeah, there's definitely a equivalent device that can be launched in the crypto land, I think. But I'm surprised I didn't know about this. Maybe I'll look it up and let you know about that.
Yeah, and the second question I had was, if code is indeed the law when it comes to DAOs, right? That's what they keep saying. Code is law.
Code is law.
But why the hell would you choose a Python-like language to express it then? It is very hard to reason, right? I would think they would have chosen like something like Lisp or Haskell or one of those functional programming languages to express it. But why would they choose Python?
Actually, there is a couple of flavors of those languages. The Python version actually didn't take off that much. It was called Viper, and it didn't take off that much. Okay. The current, I would say, the most common language is Solidity, which is the Ethereum's, I would say, programming language. Of course, Ethereum follows a Java-like structure where they have a EVM, like a Ethereum virtual machine. So you can write your own language that compiles to EVM, and EVM is what actually runs on the decentralized computer. So the current flavor is like this thing called Solidity, which is a very Java-like language. So it comes with a bunch of baggage, which is a part of I think the Java heritage. But it's not that hard to reason about. I have read a bunch of these Solidity smart contracts. It's fairly easy to reason about. It's not that complicated. It has type safety and a bunch of other things. Of course, you could shoot yourself in the foot very badly. So most of these, of course, the DAO, the famous DAO which happened in 2016 got hacked because there was a bug in the code which was very subtle, by the way. So what happens is when somebody calls a function, if the function calls back if somebody calls a function and the function can call the caller back, and you get into this recursive loop, and if you don't protect against that, then the caller can say that, I'm going to deposit some money, I'm going to get some change, and the change can be greater than something. And he actually did this whole loop, and he drained the contract completely. So these they're called reentrant calls, and those reentrant calls are like they have to. So the long story, to cut a long story short, analyzing Solidity programs and guaranteeing that they are bug free is a very hard problem. And these code auditing companies are making a killing now, because any smart contract that has to be deployed on the Ethereum blockchain, without a code audit, nobody will at least code audit is like, of course, after audit also you could have a bug, but the audit gives you some sense that, some serious people have looked into the code and before it was deployed, and then your capital is somewhat safe if you want to deploy some capital into that contract. So yeah, there is a lot of other issues like, smart contract auditability is like a big one of that.
Okay, but it's all like Java-like code, right? I'm just surprised, they didn't migrate towards a functional sort of language.
I think it's mostly also about the developer mindshare. It's easier to get a C Java-like programming language to get wider adoption. I think that's where it comes from. It's nothing. There's no other deeper insight there, I think. Okay. They just wanted to get the most number of people who could code as fast as possible.
Right. So where do you think this thing is headed? Is there any juice in this thing, or in this whole movement? Like, what are the typical use cases you see nowadays for these sort of DAOs?
So there are two types of, I would say, DAOs in some sense. So those where you have a very specific purpose, like borrowing or issuing a stable coin or funding some project which no returns in expectation, right? Just funding, not expecting returns. So if you have these kind of very specific use cases, you could have a DAO and it will work very well. So you could call Compound the lending protocol, or MakerDAO the stablecoin protocol. They are all like DAOs in some sense, because they have their own token which is used for changing the rules of the DAO. So you have this governance a token that can be used to vote, and you can vote in changes to the rules and stuff. But the critical DAOs that we want as consumers is a general purpose DAO, where, as you were saying, let's say you would want to give a task to somebody and the person completes the task, and that's when the money gets kind of released to them, right? This is a much harder task, because a heterogeneous notion of what a task is and what it means to be completed and how that is manifested on chain. Like, you have to get this data from the external world into the the blockchain world, right? So for a standard thing like lending protocols, there is only one data point that you want from the external world, which is the exchange rate or something like that. And there you could have like, one oracle which will tell you what the rate is coming from, like a trusted oracle, let's say, which is also decentralized. It collects a bunch of feeds and does something, but still it is sending one data point, or like something standardized, like, the weather in New York, or it's sending like, the dollar euro exchange rate or whatever. But telling me whether, Shyam completed this particular essay by 2:30 in the night or whatever, for a centralized oracle will not even care about that. There is just too many such tasks. So getting this data on chain, or at least representing a real world task with an on chain kind of artifact, I think is the research challenge here. If that is somewhat mitigated or somewhat solved for let's say a whole swath of tasks, then you could consider like a more heterogeneous DAO, and that will be a game changer. Because then you could, like, if you remember our private conversation, you asked about this whole idea where you want to have these freelancers who are working for you, and you want to kind of set up tasks and get them paid, or get the workers paid once the task is done, and all of it is automated entirely. And for that, the automation of the last part, where the task is done and you can check whether it's done, that I think is like still a missing step, because it has to be on chain, and that's the critical part. In the real world, you can physically check the task, and you can you have an estimate of whether it's done or not. But defining that as an on-chain artifact that can be repeatedly executed is not that trivial, I think.
So Tejaswi, I have a question. How's it different from, say, like algorithms just running? Like running things.
It's basically the decentralized part of it is the only difference. So if you have an algorithm doing the same thing, and the algorithm runs on Amazon Web Services, and it is run by some company called Kishan Incorporated, and if it's doing something nefarious, they will come behind Kishan Incorporated and say, kill the algorithm, right?
Right.
And this time, the DAO is, you can't really kill it because it has a life of its own. There is no. So this is an interesting question, I think, which you can kind of talk about as well, which is if something bad happens, who is responsible, right? Who will the regulators or the legal people go behind? Is it the developer of the smart contract, which is sometimes the developer's identity is fairly open as well, but they just deployed the code and they kind of went away. They didn't have any financial motive from it. Is it the people who control the governance tokens? But those are sometimes anonymous. It's not very easy to see who they are. Sometimes they have KYC. Like, for example, if you want to buy a governance token of, say, Compound on some centralized exchange like Coinbase, then people will know who is the owner of these particular tokens. So it could be that as well. So it's the idea of who is responsible if shit hits the fan is not very clear. And also, as I was alluding in the essay itself, whether these tokens count as securities is also kind of an open question, because they sometimes do have cash flow coming in from the token holders.
Okay, but then can you see one application where this will work? Because like most things, you have like I mean 1% or a team, and it's their like enterprise, which makes a difference, right? In which makes the world a better place of, it introduces like a new idea. Yeah.
No, you're right.
So,
I mean, for as of now, for example, most of these DAOs are actually promoted by a specific team. You are right. There is no, I mean, the promise of a DAO is that it's entirely promoter-less, right? There's no promoter, there's no organization that backs any DAO. But in real life right now, Compound is backed by a company, it's got venture funding. Uniswap was one guy who launched the code. It was an ideal case where this one guy just wanted to learn how to program, and he launched Uniswap, by the way. It's a story for the ages. There's a meme that says, from Iron Man, there is a movie, in Iron Man movie, there is a scene where this guy says, Hayden Adams was able to build Uniswap in a fucking cave, right? What are you guys doing? So this one guy, he built Uniswap from scratch, just sitting, and he didn't even know how to program, by the way. He was a mechanical engineer. So that was one of those cases where, it really was like, some guy wrote code, deployed it, and it kind of became a thing of its own, right? But then, of course, they launched Uniswap V1, V2, V3. Now it's a big organization. It has advisors, it has venture capital, whatever. It's now completely a different story. I personally believe that any of these can become promoterless. The promoters could just disappear.
Yeah.
But why would they, right? Why would they disappear? Because they have governance control over protocols. So if somebody tells that this is just a facade over something like a centralized system, and just, it's a good thing to kind of talk about and pump to the consumer and tell them it's different than, what you've seen before. So you can tell them that Ethereum is different than Google, or you can say that, the Compound DAO is different than the Bank of America. You can say that because it's a DAO, right? It's cool.
Yeah.
But, unlike Bitcoin, where Satoshi did disappear, he's truly, or he or they is truly gone. There has been no trace since 2010. And there's no founder, there's no founder token, there's no reward, there's no pre-mine. There's no real identity behind the founder. It's a truly kind of, promoterless thing. DAOs, I don't think are there yet. I mean, I would argue even Ethereum is not there yet, or neither is Binance Chain, neither is Ripple, IOTA. There are 1,000 blockchains. They all have promoters. Ethereum is the closest to not having a promoter, I would say. It's a foundation, and the foundation doesn't have that much control. So you could argue it's kind of, not promoter driven. But fundamentally, I think, as of now, I think, in my opinion, again, as you guys know already, I'm a Bitcoin maximalist. Bitcoin is the only promoterless system out there right now.
Yeah, and I think, most of this is appropriating the word protocol, because when you say protocol, the first thing that comes to mind is TCP/IP, right? So, and who the hell wants to be in charge of TCP/IP? If you look at the RFCs for that stuff, you want to blow your brains out. So,
I have written an RFC, by the way. It was a shit show.
So calling it a protocol is basically appropriating it, and I don't think this is anything to do with an actual protocol, which is getting everybody on the same page, and it's a more deliberative process rather than a bunch of people deciding what it is in code. So if So anyway, I see this, in Bitcoin all over the place. I mean, not Bitcoin, but in this whole crypto thing all over the place. Yeah. So they just appropriate all these existing stuff that means something else, and it's not even an adjacent use. So they just say that this is what it is. First of all, it's not a network. So what exactly is a network? This is not a network. So yeah, so I've seen this happen, but and back in 2016 when this DAO, the first thing was popular, I do remember thinking about it, right? So for example, right now all financial assets are digital, right? So it is not impossible for the DAO to have access to your brokerage account. It's just an API link. So why is it not possible?
No, it's not as easy as you say it, right? I mean, the DAO ideally runs on a decentralized network of computers. When you say it has access to your brokerage account, what does that mean? How do you actually do it? It's not obvious at all, by the way. Currently, I'll tell you, for example, how a centralized exchange rate of, say, USD to euro is actually put into the compound protocol. So I'll tell you how that works. It's like bizarre, by the way. So what happens is there is a centralized operator who knows the exchange rate. So in the compound protocol, there is a code which says at 2 a.m. Anybody every 2 a.m. Of the day, like a cron job of almost anybody, a non-privileged person, can make a function call that updates the local storage of the value USD to euro. So anybody can make the function call, but they will say that if Chainlink is the Oracle company, they call it, then that will take priority over the rest of them. And that Chainlink will have a specific public key that will be has to be signed by the private key, right? Now, Chainlink is actually calling a function on the DAO protocol or the compound protocol to input the data. So in your case, in the case that you were giving an example of, say, your brokerage account data going into the DAO itself or the compound protocol or whatever it is, somebody who knows your brokerage details has to make a function call. It could be you, for example. You could make the function call saying that I want my brokerage data to be uploaded to the DAO right now. That could work. So what you have to understand is it can't be pull based. Like the Ethereum smart contracts cannot pull data from the outside world. Somebody has to push data into it. That's the only way it works, because in a typical use case, what happens is there will be a single endpoint you can call, and that endpoint doesn't exist. Like the DAO doesn't know what the endpoint is, and you can't have a cron job in it. Somebody has to actually make the function call.
So my fantasy was this, right? So you link a specific brokerage account to your DAO, right? Okay. And then whoever has the governance token, they vote on what the brokerage account should do next, like buy, sell, whatever. Right? So it's by voting based. So whichever wins, the DAO executes, and since it's linked, something blah blah blah. So that was what I was thinking about.
No, so you could do that even otherwise, right? Like for example, Zerodha could come up with a pooled account where the pool.
Yeah, so that's illegal.
Or whatever. Is that so?
Yeah. So
welcome to cryptocurrencies where all the illegal stuff becomes legal because the regulators don't know what to do.
No, it's decentralized, right? So it's decentralized and autonomous. So it can do whatever the hell it wants to do. So, so in this case, what it is doing is it is pooling the the collective wisdom of different people who happen to contribute cash as well. So in order to go and do something else. So I was thinking about this, but I don't know. So the thing is this, right? So wherever there is a KYC barrier, that's where it starts getting traceable. So in order to open the Zerodha account, I need to do KYC. So if they find out that this DAO is doing something with this particular account, they can come and catch hold of.
No. I'll tell you what you can do. There is a bunch of stocks that are represented on the Ethereum blockchain. They're called synths, synthetic assets.
Oh,
so you have synth Tesla, synth Google, synth Microsoft. They're all already available on the Ethereum block. So they're all ERC20 tokens whose price value tracks the Tesla price.
Unbelievable. Okay, this is.
Are you surprised? Are you surprised? So this is the protocol is so the protocol that issues all these ERC20 token is called Synthetix, SYNTHETIX or whatever. So Synthetix is a protocol which issues all these synth assets. And how do they actually back the synth asset? For example, if ERC20, let's say if a Tesla, so they don't hold a Tesla share. So that's the whole thing, right? If they hold a Tesla share and then give the ERC20 token for every Tesla share, that would be reasonable. They actually don't hold a Tesla share. So what the protocol does is it holds over-collateralized ETH, which represents the Tesla share. So they have 8x over-collateralization. So if the Tesla share doesn't tank by 8x, they can cover it. If it tanks by 8x, it's game over. So look up Synthetix. It's madness.
Unbelievable.
Are you surprised?
But why didn't they do, what do these Europeans do? CFDs, right? So a CFD is very similar. Like so before this whole crypto stuff, right? You could buy a CFD which bets on the FTSE, at 2 p.m. local time.
Interesting.
Right? Yeah. So CFDs were was the way people gambled, before this. Yeah. So this are all like synthetic trackers. So they can track anything, for example.
Yeah, exactly. They show in the Big Short, right? So there is this 2 people playing poker, and there are like this whole bunch of people betting on, whatever. Yeah. So yeah definitely.
Yeah. So the thing is, you're owed the difference. So it's just a certificate for difference or something like that. So so you can technically have a legit corporation in Cyprus or whatever, right? So in one of those blockchain friendly countries, and actually manage this as a basket of CFDs. It's possible. You don't have to do all this 8x collateralization and all, because managing risk on a basket of CFDs is a known thing. It's a known.
CFDs, how does the CFD handle volatility? Like, for example, if an asset value collapses or at least goes up super high, how does it actually give out the difference? Where does the money come from?
So, well, first of all, it's not a one-sided market, right? So how much money you pay for that CFD, right?
But they are assuming that the market kind of balances out very easily or very well.
Yeah, it's like any bookie. Right. So if you're, if you're a bookie for a horse race, right? So, what you do is, you have to assume that, the first 15 minutes when you open your book, you're going to be taken to the woodshed by the punters who know the odds and everything. But that 15 minutes help you, update your priors. Yes, so like Bayesian updation.
Pleasing the regular customer, right?
Yeah. So when the regular guys come in, it's already updated, the bid offer. So similar thing happens with CFDs as well, because there's a CFD almost launched every hour, betting on what happens the next hour.
I have to read about this. I just know about Synthetix right now, which is actually doing something similar, but they are playing it safe because they want not to, like, they don't want the protocol to run out of money, basically.
Right. So the thing is, the trick is in managing your bid offer. So as a bookie, that's all you care, right? So how much do people pay for this risk? And, and that is a known way to manage that risk as well. So because that for every Tesla buyer, typically there'll be someone at some price who is willing to take the opposite side of the trade.
Definitely. No, but I think the advantage is if you have enough liquidity or if you have enough demands from both sides, you can pull this off.
Yeah.
But I imagine some of the time, some of the instruments might be too exotic to have demand on both sides. But anyway, so this is like, so your use case of having a brokerage connected is kind of taken care of.
Yeah. So that's pretty cool, actually, because if they have a synth for all S&P 500 stocks and the index, right? You basically have made.
But you go on. I didn't hear the last part.
No, what I meant was if you had a synth for every S&P 500 stock and the index, right? So that's what you basically need. The entire financial, half of finance is just gambling. Right. So all this bullshit about saving for retirement and all that is a very small part of the entire volume that happens. So most of the volume is just outright, speculation, high frequency trading and that kind of stuff.
I find your cynicism very refreshing.
So no, look, it is what it is. So even in this crypto land, right? So the story is, yes, it's freedom and this and that, blah. But when you actually drill down to it, what is it? It's just speculation. Most 99.9% of the flows is speculation, right? So so it's the same case everywhere. You take any asset, any financialized asset. This is what you end up with. And so what happens when you do a synth version of all these stocks is that all these guys will now start making markets in crypto line, because it's just a logical next step. They'll be idiots not to do it.
No. So the synths trade on Uniswap, obviously.
Obviously, yeah. Oh man, this is there is no depth to this.
No, but think about it. Synth is the ERC20 token, and Uniswap can trade any ERC20 token pair. So that's the advantage of standardization, right? I mean, they did this standardization, which if you hope the real world would have it, right? Where every API could talk to each other, all of them were composable. Things would be much more smoother and maybe dangerous, because it would be too closely tied together, and the systemic risks would percolate very quickly. But the flip side of it is it just works like it's like having a very powerful API that you can build upon each other very quickly. So this ERC20 token API was actually a stroke of genius from the Ethereum Foundation. Now kind of every asset on Ethereum is an ERC20 token, and they are composable with each other. So you write your exchange to handle that. The new asset is just easily listed like within a second, right?
Right. So now I get it. So Virtue Financial, you heard of that, right? So it's so it's a huge high frequency player in the US. Yeah, and it's one of the listed guys. So, and I would say it's one of the good guys, because there are a lot of malicious high frequency guys as well. So Virtue was one of the first guys to recognize the value of making markets in crypto land. And unlike so their public markets model is all hidden and very secretive and all that, but they've taken an entirely opposite tack when it comes to crypto. So everything they're doing in crypto is out in the open. So now I get why why that is so, because they want more and more people to come into applying the regular finance stuff into into crypto land. And one of the things in finance, right? So if you're trading, if you have an edge, then it makes sense to just trade rapidly, right? You make as many transactions as possible. So if you have an edge in a transaction, just make as many as possible across different markets as possible. If you're wrong, then you're proved wrong very fast, right? You don't have to wait like a decade to know whether you're right or wrong. And if you're right, then every day you take money, money to the bank. So that's one of the things that I think they are trying to bring to crypto land.
Yeah, it should be fun. I mean, but the thing is, because right now the crypto ecosystems already have a bunch of these fundamentals built in, like exchanges, credit, stable coins. They're all kind of built in already at some level. And of course, there are also, by the way, if you look at yield finance, there is a whole bunch of, they have this idea of having a basket of assets which can be bet on separately. Like you can have indexes of random things as well. There is that available. So there are all these ideas which have kind of already been done as protocols, if you will. But of course, they are all done by promoters who have privileged access many times on the smart contract. So a lot of it is already done, and a lot of it is on the way to being done, and a lot of funding is flowing into this ecosystem. So it's going to be a regulator's. It's going to be very deja vu for them, because they have to come in and again do the same things that they did in the 80s and 90s. It's going to be kind of tragic almost, if you think about it, because somebody discovered a loophole of this whole decentralized part, and the whole thing had to be redone again. We'll see how it goes. Anyways, I personally, for me, it's all sideshow, because as we all know, I don't really care about this. But I just keep in touch with what's happening because it's fascinating and fun sometimes.
Yeah, but see, you keep talking about Bitcoin, right?
So yes, me, that's the only thing I talk about.
For me, Bitcoin is kind of boring, because like 87% of it is already mined,
yes,
right? And there are whales. so there are the the 2% 2%ers in Bitcoin land, right? So who own a huge bunch of this?
That is speculation, by the way. We don't know that for a fact. I mean, the bigger wallets that are visible already, they are typically owned by exchanges because they have this large cold storage, which the Coinbase's wallet would be like a whale. But that's not truly a whale because unless, of course, they cheat their customers, they're not truly a whale in some sense. So real whales are not as many as you would think. For example, MicroStrategy is a whale now, which we know because he has bought a lot of Bitcoin. The Winklevoss brothers are whales. Satoshi Nakamoto himself or herself or themselves is a whale as well. But there are not as many whales as you would think because I've done the analysis of the histogram of the account balances. It's not that much. And also tying all Bitcoin also doesn't have an account model. So you can't tie all the UTXOs together as well. So sometimes a whale could exist, but with different addresses as well.
Yeah.
Anyway, so what is your point? The point is if there are too many whales?
Yeah. So my point is that, all these whales, they have like a sort of built-in need to keep attracting newer and newer followers into Bitcoin to keep that price at a certain level, right? So if a new entrant comes in, it's very difficult for him to actually mine Bitcoin and make it his own. He has to buy it from one of these whales, right? So it kind of self-perpetuates the price higher and higher. It's not something.
No, if you look at it, I mean, when the prices went higher over the last, say, 12 months, in late 2020, early 2021, CoinDesk has a bunch of analysis on which addresses were the ones who are selling. The sellers were not the ones which bought Bitcoin in 2013, by the way. The sellers were people who bought it in 2020. So the churn is fairly high in the later part of the decade. The earlier part of the decade either is lost coins because people have just kind of completely forgotten their private keys, or they are not involved in this price action at all. In some sense, they are building things, or they are. I mean, so if you take a step back forget price for a while. If you take a step back all the way, currently there is, if you want to think about any sort of check on the M2 money supply, there is no other thing, man. There is nothing else which can keep M2 in check. So what is your take on what will happen if M2 keeps increasing?
I don't care.
You don't care, really?
I don't care. M2 has nothing to do with my life. That's what I mean. See, the thing is, there are a lot of instances where, the stock of cash has gone up, but the motion has not. So more than M2, you should be worried about M3.
Yeah. So if you look at, I didn't say M1. M1 is like M1 is the case where it actually doesn't come to the real world in some sense.
Yeah. So even now, so what is the real world, right?
No, M2 includes bank balances of people, by the way.
That's fine. Okay. But aggregates always lie, right? So the thing, what you should be worried about is actually M3, the rate at which that money flows through the financial system, not just as a stock. So for inflation or whatever, assets degrade.
So hang on. So can we take this over in the next episode of Freefloat? Because I have a lot of opinions on this one.
Okay. All right. So makes sense.
Yeah.
We kind of drifted off DAOs anyways.
Exactly.
Yeah. So Kishan, do you want to ask any question around this?
No. I mean, I think I'm still new to DAO.
Yeah, it's fascinating. I think the essay should open up a few ideas, and it's fun to read about it.
Yeah,
for sure.
Absolutely. So thanks, Tejaswi. So we'll wrap this episode of Freefloat. If you have any questions, do leave comments, and Tejaswi will get back to you. So until next week, bye.
Bye.